Mortgage rates have risen rapidly, which means that the cost of buying a home is rising, which means that housing prices must fall? Seems simple, doesn't it? It's not that simple. To know whether the rapidly rising rates of today will lead to a home value decline, we have to understand the real relationship between mortgage rates and prices. I'm going to show you historically what has happened when mortgage rates rose quickly and then fell quickly. We're going to take a look at that hidden variable that determines whether home prices will also fall as rates rise. It is not a foregone conclusion. I'll explain it all in a few minutes, but the first thing you need to know is that there are more than two variables in the home price equation, and a lot of people act like there are only two variables, rates and housing prices. If you leave out the third variable, you are not going to be able to solve the equation. I was listening to Jason Walter earlier this week, and he was talking about the astronomical effect interest rates are having on mortgage payments.
If rates increase 4 percentage points, that decreases buyers' purchasing power by about 40%, which is just mind-blowing. So 1 year ago, the median sold price, according to Redfin, was $344,000. That's a national median sold price. 1 year ago as well, rates were at 3.18%. So the P&I payment, based on this scenario right here, would be $1,187 per month. Fast forward 1 year, the median sold price $368,000 at 7.2%. The new payment would be just under $2,000, $1,988 per month. And by my math, that's an increase of $800.
Now, I don't disagree with his math. These higher rates are definitely making home ownership more expensive, but I do take issue with the leap that some people make, assuming that these higher rates must necessarily lead to home price declines. The first thing we need to understand, and this is just a small piece of the puzzle, but it's worth noting, is that measurement most people use to describe a declining market is a poor yardstick. The measurement used is almost always the median home price. It's a useful metric, and I'm going to use it today, but we have to understand its limitations. If the median home price is lower today than it was last month or last year, people say the market has crashed. But is that really true? Just because buyers adjust their purchasing according to the cost of borrowed money doesn't mean that home values have declined. If someone could afford a $900,000 home last year and this year that same mortgage payment can get them only a $700,000 home, that doesn't mean that they're getting the same kind of house for less money. And the rate hike didn't make them drop out of the housing market necessarily, although there are probably more people dropping out in the lower price points than there are in the higher ones. It just means that the pool of buyers for the $900,000 home has decreased, and that may or may not lead to some price adjustments. But it does not mean a $200,000 price adjustment. So let's get to it and look at the relationship between mortgage rates and home prices. What we're looking at here are the average 30-year mortgage rates by year and the average of the monthly adjusted median home values by year. What's the adjusted median home value? I'm glad you asked. I hear a lot of people talk about when interest rates were so high in the 70s, it didn't matter because home prices were so much lower. And it's true, home prices were lower, so was a loaf of bread.
You can help them grow bigger and stronger with Wonder and Rich Bread. Build strong bodies.
However, incomes were also so much lower. The adjusted median home value takes into account that lower income and the lower home price so we can compare apples to apples. I pulled a lot of this information from online sources, which I will link to in the description below in case anybody wants to see it. Let's start in the late 1970s, 1977 to be exact. On my birthday, mortgage rates were 8.8% and median home values were just over $190,000 adjusted value. In 1978, mortgage rates rose to 9.6 and home values rose to just under $205. In 1979, mortgage rates rose to 11.2 and home values rose to $212,000. Not what many people would intuitively expect. The yearly average rate rose 2.4% in 2 years and home prices continued to climb. But then the 80s hit. By 1981, the average 30-year mortgage rate was a whopping 16.6%. That's a 48% increase. And home values began to fall from $212,000 in 1979 to $198,000 in 1981. That's a 6.6% decrease in value. That's what we've been told must happen, right? There was just a lag, and that explains it, right? Not so fast. It just isn't that simple. When mortgage rates fell almost 3% from 1982 to 83, home prices remained almost constant with just a slight decrease in home values, even though the rates dropped by 3%. When rates remained steady in the second half of the 80s, prices rose. When rates fell in 91, home prices fell as well. When rates were at 7.3% in 1993, down from 10.3% in 1989, home prices had fallen from $228,000 in 89 to $209,000 in 93. That's a drop of 3 percentage points, and yet prices still fell. There just isn't a quick and easy correlation between yearly rates and yearly median home prices. Let's jump ahead in time just to solidify the point. From 1998 to 2000, interest rates rose and home prices rose. From 2000 to 2003, interest rates fell and housing prices rose. From 2006 to 2011, interest rates fell and home prices fell. From 2016 to 2018, interest rates rose and so did home values. But wait, you say, time out! These interest rate hikes are coming fast and furious. These are different. And hey, you don't have 2022 on the graph. You're right. The Fed is moving quickly and dramatically, and the data sets I used to put this graph together didn't have data for 2022. So full disclosure, I've added the 2022 data from different data sources. Currently, the yearly average mortgage rate for 2022 is 4.95%. And the median home sale price is $384,000. Rates up, prices up. Again, there is simply more to the equation than interest rates. It is true that by the end of 2022, the average interest rate is going to be higher than the current average of 4.95. Will the yearly average rate rise to as high as 6%? If so, that will be a 3% jump in just a single year. The only other single year that saw that kind of jump was from 1980 to 81. But what's important is not just that the rates have jumped so far so fast, but why the Fed is doing it. And that is what leads us to the missing variable. You guys, I have uncovered some numbers that are going to shock you. Nobody else is saying this, and I really don't understand why. If you think about why mortgage rates increase in the first place, it'll make sense to you why housing prices don't fall with the rate increases as a matter of course. But I'm going to have to connect a few dots for you, so hang in there while I set the stage. Mortgage rates increase when the Federal Reserve raises the benchmark rate in order to slow down inflation. Inflation happens when money is cheap. When you can buy a new car for 0% interest and pay it off over 5 years, that's cheap money. But why does inflation happen when money is cheap? This is how it works. When rates are low, businesses borrow money at low interest rates, just like regular people do. Because they're flush with borrowed money, they can afford to expand their businesses. They offer higher salaries to entice higher quality employees. They take risks by starting new ventures and bringing on new employees for that. Also, consumers borrow more and buy more, justifying more corporate expansion. In time, people are buying and creating new things and buying and getting raises and buying and getting more raises and being enticed away to other companies for more money and buying until so many people have so much money that two things happen. One, they start competing with each other for goods, and two, that competition raises prices. It's like we saw with cars. Everyone wanted a new car after the pandemic. It wasn't because social distancing made people want new cars. It was because people had a lot of money. But the car manufacturers couldn't keep up. Yes, it's true that factories were shut down because of COVID infection rates, but we know the demand was high enough to cause spiraling prices even without those shutdowns, because this was happening even in the used car market, which is a much less dependent market on the supply chain. So that's what normally happens when interest rates are low. Demand increases until eventually prices start climbing. This happened with just about all goods and services over the last few years with these historically low interest rates, including housing. Housing prices going up was just part of the inflation cycle. So now let's talk about what happens when rates rise. When rates rise, we basically see the opposite of what happens when rates fall. Companies stop spending money, they decrease spending on new, untested ventures, they freeze hiring because they don't have excess cash. And while this is happening, employees might be decreasing spending themselves because things are just more expensive. And that new car doesn't look so good at 7% interest instead of 2%. But in order for prices to decrease significantly, demand has to decrease significantly. And here is the rub. Stick with me. There will always be some decrease in demand simply because the higher prices get, the fewer people can afford to buy things, and so the less they buy. And this might keep prices from spiraling, but some people can still buy them, so that means prices might not fall immediately. Prices have to be high enough that a larger number of people cannot afford to buy goods and services, taking the pressure off of things. If a modest interest rate hike is enough to relieve the pressure and allow the supply chain to function properly, then great. We've just had one of those minor fluctuations that no one makes YouTube videos about. Who am I kidding? But if demand remains high, even though rates have increased, that is when there could be trouble. And this is where we seem to be right now. If demand remains high for goods and services, meaning that prices are still increasing, even with high interest rates, that means too many people still have money and still want to spend it. And so rates need to increase further. At some point, the cost of money and the ripple effects of that cost compels companies not only to stop expanding, but to contract. They start decreasing the existing product that they're developing because eventually no one's buying it anymore, which was the point of raising rates. If they start decreasing the product they're developing, they lay off employees. When people don't have jobs, they tend to stop buying. If we have 2 consecutive quarters where we see a decrease in gross domestic products, we usually call that a recession. And if we make it into a recession, if the demand for products causing inflation is not sufficiently cooled by the rate hikes already implemented, then we will surely see some housing prices decrease. Housing prices will fall when homeowners must sell their homes to a market with a limited buyer pool. Why must they sell their homes? Because they lost their job. And so this is the missing variable, the job market. Interest rates alone will not cause a price drop. Out of work homeowners will. And here's where it gets really crazy. I pulled the job projections from a couple of different sources to get an idea of how likely it is, and if it is likely, how much effect this is really going to have on the housing market. Because remember, it's not just people losing their jobs. The number of people losing their jobs has to outnumber the number of people shopping for homes. The number of people losing their jobs needs to be enough to cause a flood of housing inventory. Is that what economists are expecting? When the Fed began raising rates, their hope was for a soft landing, which would be something similar to what I mentioned earlier, higher rates, less competition being enough to slow demand, which would stop the spiraling prices. But inflation has continued despite the higher interest rates, and now Bank of America economist Michael Gapin is describing the attempts to manage growth as likely to result in a harder landing rather than a softer one. But if we look at the real numbers, I think there's room to question the accuracy of Gapin's description, not the numbers, just how he's describing those numbers. There are numbers, and then there are the stories we tell ourselves about those numbers. Listen to this. Gapin says he expects the unemployment rate to climb to somewhere between 5 and 5.5% over the next year. Okay, what does that mean? Many economists consider anything up to between 5 and 6% unemployment to be full, healthy employment levels. We know that if unemployment is too low, it leads to inflation, so 0% unemployment has never been the goal for a healthy economy. There are always people out of the labor market looking for work for a myriad of reasons. People quit jobs and look for other ones. They're terminated from jobs for reasons that have nothing to do with the economy. Right now, employers are holding on to employees they don't really want, simply because they can't find anybody else. And the rate at which people are unemployed in a healthy economy is between 4 and 6%. Our current rates of unemployment are too low, and this is part of what's driving inflation. Yes, and printing money too, but let's stay on track here. So to restate what Gapin is actually saying, the Federal Reserve will achieve a hard landing of healthy employment levels. I don't know about you, but that's a bit of a head scratcher for me. The hard landing on the employment front is just reaching healthy unemployment numbers. For comparison's sake, the 2008 crash saw unemployment levels between 7 and 10%. The Federal Reserve is expecting more of a modest unemployment rate of 4.4% in 2023, and TD Economics is projecting unemployment to hit 5.1% in 2024 before settling back in around 4%. Basically, next year we'll be getting back to the unemployment levels of 2014, 2015, and 2016. And that was a strong economy. And this is what nobody is saying. The coming recession will simply get us back to a normal economy. Why are they not saying this? You can see as well as I can that it's true. I didn't make these numbers up. Is the recession news, or is this just normal? Maybe they're expecting much higher unemployment rates and they're just not telling us. In my mind, that's the only thing that would cause a housing crash, is if unemployment levels were at the level they were the last time there was a housing crash.
I look at these sectors, John. I see strength across the board. So I would say this report has something for everyone here. A jobless rate back near the 50-year low of 3.5%. Hiring across the board.
As always, the crystal ball is out for repair, but I still haven't seen hard evidence for an imminent and dramatic drop in home values, at least here in Raleigh. Go ahead and tell me in the comments what I'm missing. If there are any good arguments against my position, I'll do the research and make a video about it. If you like this video, you might also like this one about Facebook's impact on the Triangle housing market.